This is your Wall Street wake-up call. Stocks are flat Monday as investors continue to parse comments from top Fed officials last Friday. Let's get straight to Ian Weiner. He's the head of equity trading at Wedbush Securities in Los Angeles. So Ian, it's great to see you. I thought Yellen was rather blunt when she said the case for a rate hike has strengthened in recent months. Were you surprised that she was that clear in her speech last Friday?
I mean, I'm not surprised that she attempted to sound a little more hawkish. I think she probably saw, like everybody else, that the market was not putting any probability of them doing anything pretty much through the rest of the year. So I'm not surprised, but I still think, given the reaction in the marketplace, there's still a lot of skepticism over how serious they really are about raising rates.
Well, what do you make of the fact that stocks didn't really have much of a reaction to the speech?
Well, they initially rallied, and then they kind of sold off as Fisher started to talk a little more hawkishly about what's, the reality of 2 rate hikes potentially this year.
And now they're flat.
Pardon me?
Now they're flat, stocks.
Yeah, well, I mean, the Dow was down 1% last week, so we'll see what happens. I think everybody's now kind of waiting on the jobs report on Friday to see what evidence that gives of the likelihood of a rate hike come the end of September and into December. I mean, the odds have gone up. They've sort of doubled up to 42% for September, and now they're about 60% for December, which is up from a coin flip a week ago.
Well, you mentioned the jobs report. I wanted to ask you, does this August jobs report on Friday determine whether or not the Fed raises rates in September? I mean, we all like to say that one data point doesn't make a trend, but that doesn't seem to be the playbook the Fed has been following.
I actually think it's going to have much more to do with where the S&P 500 is when they go before September 20th. Yes, the jobs report matters, but I don't think, like you said, one jobs report is going to really push them over the edge. But if it's strong enough and they come in on September 20th and the S&P is trading where it is right now, I think they can raise rates. But I think we're completely market dependent as opposed to data dependent. And the problem they have is, if you look at the other central banks in the world, they're pretty committed to driving down their exchange rates and adding more fuel to the fire. So they can't get too hawkish, because then you're going to strengthen the dollar to a point where it's going to be a big headwind for the market.
But don't you think that the Fed can sort of, determine the markets based on, the speeches that it gives or commentary from various Fed officials, right? I mean, they don't want to create too much of a bubble here by sort of leading investors in the wrong direction.
Well, I mean, it depends on how you define it. They've already created a bubble. It's a question now of, when you look at all the different Fed members, the problem is they're all out there every other day, and it isn't one message other than, well, we'll see, and every meeting's a live meeting and we're data dependent. Reality is, there hasn't been really any rate hikes for the last 6 years. So, I can see why the market is skeptical of them actually doing anything. And even though bond rates backed up a little bit on Friday, they're still nowhere near where they were just about a year ago. So, you're still in a situation where most of the market does not put a lot of likelihood on them having the ability to create inflation.
Right, and we had a rate hike, of course, last year, and then the one before that was back in 2006. All right, Ian Weiner, head of equity trading at Wedbush Securities. Thanks so much for joining us.
Thank you, Scott.
I'm Scott Gamm, and you're watching The Street.